Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover many topics related with balance sheet and statement cash flows. In this video, we're going to talk about how to prepare the statement cash flow in indirect method. To prepare the statement cash flows, we need three sets of information. First of all, current income statement. From income statement, we're going to extract information like net income, non-cash expenses, for example, depreciation expenses. Thirdly, any gain or losses related with the sale of long-term assets. Secondly, comparative current balance sheet, which means that we're going to get last period balance sheet and compare with this period balance sheet to be able to calculate any changes in current asset, current liabilities, long-term asset, long-term liabilities, and equity. Thirdly, we need information from the statement retained earnings, for example, dividend information. Let's first start from the operating activity sections, which is the most important section of all these three sections in the statement cash flows. In this section, if the section is prepared under the indirect way, we're going to start with the net income, then plus or minus any of the adjustment items from non-cash items. So net income is the very first line of this operating activity sections if this section is prepared under the indirect method. After net income, first of all, we're going to add back those non-cash expenses, for example, depreciation, depletion, and amortization. The reason for doing that is because those non-cash expenses were actually deducted from our net income when we prepare our income statement. However, since those non-cash expenses has no effect on our operating cash flows, when we calculate the operating cash flow, we need to add them back. Next, we're going to plus any losses minus any gains from selling long-term assets, for example, buildings, land. The reason I'm doing that is because those activities are not related with operating activities, they are related with our investing activities. So to reverse the effect on the net income, we plus the losses, we minus gains. Next, we're going to plus any increase in current liabilities. Take accounts payable, this type of current liabilities, for example. If some company's accounts payable increase, let's say, by $40,000, this means that the cash was not spent at the time the expense was incurred, but rather it will be paid at a later time, resulting in a liability. Accordingly, even though net income was reduced by the expenses, cash was not reduced. So that's why there is any increase in current liabilities, cash is saved, cash position is improved. And now we're going to plus any decreases in current asset. The reason is because anytime current asset decreases, for example, accounts receivable decreases, merchandise inventory decreases, or prepaid expenses decreases, the cash actually increases because you collect the cash, because you sell this inventory, because those expenses occurs without paying cash flows. So following the same logic, we're going to minus any decrease in current liabilities minus any increase in current asset. So little summary. Whenever dealing with the current liabilities, we're going to plus increase minus decrease. Whenever we're dealing with current asset, we're going to plus decrease minus increase. Okay, so this is how we actually prepare the operating activity sections, of the statement cash flows. Next, we're going to overview how to prepare investing section. Compared with our operating section, investing and the financing sections are much easier. In this section, we're going to add all the cash inflows from selling long-term assets minus any cash outflows because you purchased long-term asset. Then we get our net cash flow related with investing activities. The last section is financing section. First of all, we're going to plus any cash inflows received by the company when they issue stocks and or bonds and or notes. Then we're going to minus any cash outflows when company buy back shares from the public market, when they pay off bonds or notes to the creditors, when they pay dividends to the stockholders. So this is the financing section. In summary, your operating activity sections deals with any changes in current asset and current liabilities. Your investing activity sections deals with your, long-term assets. Your financing activities dealing with the company's, financing, transactions.